Right now, as we watch the markets move on this volatile Friday, November 21st, 2025, the live trading tape for Opendoor Technologies Inc., ticker symbol OPEN on the Nasdaq, is flashing a current price of $6.46 per share. The stock is currently down by approximately $0.24, representing a decline of roughly 3.51% for the intraday session so far. This red ink on the screen might look like a standard pullback to the casual observer, but the volume profiles and the aggressive price action we are seeing suggest something far more complex is bubbling beneath the surface. While the broader indices chop sideways, Opendoor is experiencing a distinct decoupling from its sector peers, driven by a unique collision of short-term technical selling and a massive longer-term strategic pivot that is confusing even the most seasoned analysts. Most investors looking at this chart today see a struggling real estate company getting hammered by high interest rates and a frozen housing market. That is the expectation, that Opendoor is simply a victim of the macro environment, a leftover relic from the easy money era of 2021 that is slowly bleeding out as mortgage rates remain elevated. But the reality is vastly different and significantly more explosive. The reality is that Opendoor is no longer just a home flipping business, it is aggressively transforming into a software and artificial intelligence entity under new leadership. And the volatility you are seeing today is not just liquidation, it is a battleground between deep value institutional accumulators and a massive short interest that is increasingly trapped. The narrative expectation for Opendoor has long been that it is a capital-intensive, low-margin business that cannot survive without near-zero interest rates. The common wisdom on platforms like SoFi Invest or among chatter on Robinhood stock trading forums is that if you buy Opendoor, you are betting on the Federal Reserve cutting rates. But the reality emerging in late 2025 is that Opendoor's correlation to interest rates is beginning to break. The company's recent Opendoor 2.0 initiative, spearheaded by the newly appointed CEO, Kazneja Tan, former COO of Shopify, is fundamentally altering the unit economics of the business. By replacing human-heavy underwriting teams with automated AI-native models, the company is attempting to slash operational costs to a degree that could make them profitable even in a stagnant housing market. This expectation-reality gap is where the profit opportunity lies. The market is pricing Open as a distressed real estate asset, while the internal metrics are beginning to resemble a high-growth software platform. If the market wakes up to this reality, that they are valuing a tech platform like a brick-and-mortar flipper, the repricing event could be violent and rapid, which explains the extreme volatility we are witnessing on the tape today. Analyzing the specific intraday movement we are seeing right now, the drop to $6.46 is testing a critical liquidity zone. Technical traders using Interactive Brokers trading platforms will notice that this level aligns with a previous consolidation block from early October. The selling pressure this morning appears to be algorithmic, likely triggered by a breach of the $6.60 support level earlier in the pre-market session. Volume is ticking up, which is often a signal of capitulation from weak hands, retail traders who bought the hype last week and are now panic selling as the price drifts lower. However, looking at the order flow, we are seeing absorbing bids sitting just below $6.40. This suggests that while retail sentiment is souring, smarter money is stepping in to soak up the supply. It's a classic shakeout pattern. When you compare this price action to something like Tesla stock or Nvidia stock, which often move on pure momentum, Opendoor is moving on structural mechanics. The recent announcement of a warrant dividend, distributing tradable warrants with strike prices of $9, $13, and $17 to existing shareholders, was a masterstroke of financial engineering designed to punish short sellers. Short sellers who are borrowing shares of Open are now liable for these warrant distributions, effectively increasing their cost to hold the position. This has created a ticking bomb dynamic in the stock, where every dip is potentially a trap for bears who might get squeezed if the price reverses. It is fascinating to observe how different demographics are reacting to this. If you check the activity on Fidelity Investments forums or look at the flow into Fidelity ETFs that hold small-cap tech, there is a hesitancy. Traditional wealth management clients are staying away, spooked by the volatility. In contrast, the Robinhood app users and those engaged in SoFi active investing are heavily active,
treating Opendoor as a high beta proxy for a market recovery. This divergence creates liquidity gaps. When one side of the market is purely speculative and the other is completely absent, price discovery becomes jagged, leading to the 3 to 5% swings we are seeing today. The $6.46 level is not just a number, it's a line in the sand. If the stock closes today below $6.40, it could open the door to a flush down to $5.80. However, if buyers manage to reclaim $6.70 by the closing bell, it would form a bullish hammer candle on the daily chart, signaling a potential reversal heading into next week. This is why watching the live price is so critical. Yesterday's data is useless in a scenario driven by real-time liquidation and accumulation algorithms. Let's pause for a moment and consider the broader landscape of online investing. Investors today are inundated with tools, from Schwab Intelligent Portfolios that automate asset allocation to Fidelity trading platforms that offer deep technical charting. Yet despite all this technology, the emotional component of trading remains the same. The fear driving the price down to $6.46 today is the same fear that drove markets 100 years ago. The difference now is the speed. With Interactive Brokers stock trading allowing for millisecond execution, a 3% drop can happen in the blink of an eye. For individual brokerage account holders, this speed can be terrifying. You might log into your Fidelity mobile app and see your position down significantly before you've even had your morning coffee. But this is also where the edge is found. Algorithms react to price. Humans can react to value. If you believe the reality of the AI pivot over the expectation of the housing crash, these dips are merely noise in a longer-term thesis. The fundamental backdrop for Opendoor has shifted dramatically in the last quarter. The Q3 2025 earnings report was a mixed bag that perfectly encapsulates the current confusion. Revenue came in at $915 million, beating estimates of $850 million. This indicates that despite the frozen housing market, Opendoor is still managing to move inventory. They are selling homes. The demand is there. However, the earnings per share, EPS, missed slightly, coming in at a loss of $0.08 versus an expected loss of $0.07. The algorithms read EPS miss and sold the stock, but the human analysts reading the transcript saw something else. The contribution margin, a key metric of profitability per home sold, is improving. The AI tools they have deployed are allowing them to price homes more accurately, reducing the risk of holding bad inventory. In the past, Opendoor would buy a home, the market would turn, and they would be stuck with a loss. Now their predictive modeling is getting sharp enough to anticipate these turns. This is the tech part of the PropTech label finally starting to work. It's less like a real estate agent and more like a high-frequency trading firm, but for houses. It's worth noting how this compares to the broader Mag 7 or big tech narrative. Everyone talks about Apple stock as a safe haven, or Nvidia as the AI kingmaker. But those trades are crowded. Every Fidelity Wealth Management advisor recommends them. Every SoFi robo-advisor has them in the portfolio. Opendoor is a contrarian bet. It is hated, it is heavily shorted, it is volatile, but that is exactly why it offers asymmetric upside. You don't get a 5x return buying Apple stock at all-time highs. You get it by buying a distressed asset like Open when the market completely misunderstands the turnaround story. The pivot to an asset-light marketplace model, where Opendoor connects buyers and sellers without taking the home onto their own balance sheet, is a massive development that the market is currently ignoring. If they can pull this off, they transform from a capital-intensive flipper to a high-margin software middleman, similar to how Airbnb owns no hotels or Uber owns no cars. The market is currently pricing Open as if it owns thousands of depreciating houses. If it starts pricing it as a platform that facilitates transactions, the multiple expansion could be enormous. Speaking of engagement, I want to hear from you guys right now. Comment below how many shares of Opendoor you currently hold, and more importantly, what is your average cost basis? Are you underwater from the 2021 highs, or are you a new buyer entering at these single-digit levels? Also, do you think the new CEO's plan to ruin the night of short sellers with these warrant dividends is a brilliant move or a desperate distraction? Let me know in the comments. I read all of them to gauge the real sentiment out there, which is often more valuable than any Wall Street analyst note. Now let's look closer at the competitive landscape. You have traditional players and you have the new fintech disruptors. Fidelity mutual funds and Fidelity IRAs are often filled with traditional home builders like D.R. Horton or Lennar. These are safe, steady businesses. Then you have the Robinhood crypto crowd that looks for the next moonshot. Opendoor sits awkwardly in the middle. It deals with physical real estate, which feels boomer, but it uses AI and algorithms, which feels tech. This identity crisis is partly why the stock is so volatile. It doesn't fit neatly into a Schwab Intelligent Portfolio bucket. Is it tech? Is it real estate? Is it financial services? The answer is yes, and that complexity scares off the passive money. But for those who engage in self-investing, who take the time to read the 10K filings and listen to the earnings calls, the complexity is where the alpha is hiding. The recent insider buying is a signal you cannot ignore. When executives use their own money, not stock options but cold hard cash,